We're just waiting on Tiana.
Okay. That looks like Tiana is back.
Yes, she is. So we can continue now, miss.
All right. Right. So we were just talking about insurance and the fact that insurance is a less than straight up, honest, straightforward business, but that's not really what we are here about necessarily, except to say that insurance is one of the things that as a that is used in lending to mitigate credit risk, right? So what Mr. Shan was sharing was an experience where, uh, as it relates to motor vehicle insurance, that the insurers penalize drivers even though they meet in accidents and it's not their fault. And that in and of itself is an unfair, unjust approach that the insurance companies take. Um, and it's one of the things that insurance companies in America compete on. It's one of the areas that they compete on. Some of the insurance companies in America will say they have accident forgiveness. So whether or not you were wrong, they will forgive you and they won't penalize you and increase your insurance premiums as a result. In Jamaica, though, most of them, whether you're wrong or you're right, they want to increase your insurance premiums once you meet in an accident because they don't like to pay out, right? So that's one of the things that Mr. Shan was talking about. And the other thing he mentioned was that the NHT, which was an institution that they say they brought about to make housing more affordable for the people of the country, also embarked on a venture where they built some premium housing solutions, which were priced out of the reach of many Jamaicans. And there was protest in relation to this particular um, building venture that the NHT took on. Um, and eventually there was some damage that took place to that particular place that they built because they probably never built it too proper. And the basement where persons parked was flooded out. Again, insurance would come into play because all the vehicles that were parked down there would have been flooded out. If you had third-party insurance down there, you'd be crying because you have nothing to get. The only likely persons who would have gotten something were those who might have taken a loan on those vehicles and would have had to insure them comprehensively. So you have comprehensive insurance versus third-party insurance for motor vehicles. And when they insured comprehensively now, they might have an opportunity now to get some funds back based on that act of God. And even then, there's no guarantee because some of these insurance companies, and we say, it never insure for that.
Yeah, and I fully 1,000% agree. Let me just clarify something though. The reason I made mention of the insurance in the way that I made mention of it, because again earlier I spoke about risk. Um, the when one takes out a motor vehicle on you know on a mortgage, and something like this were to happen, it increases the risk of you defaulting on your payment because now it is that you have to quote unquote fork out more money to either repair the
Mm-hmm.
car, you may default on
Mm-hmm.
your loan payment to pay the
Mm-hmm.
insurance, you may default on your loan payment. So your risk, you are increasing your risk now of defaulting on that loan, and then
Mm-hmm.
now you're putting yourself into problem. I don't know if I'm correct, but that's what I'm just thinking. So that's where I was going in my whole headspace, tying in what it is that you spoke about earlier in terms of credit risk, the risk of
Mm-hmm.
whether in this case whether it is secure or unsecure. But of course, if it is unsecured, you're in much more problems than if you took
Yeah.
a secure one. But I think it can increase the risk of you defaulting on your loan when there's an
Right.
increase in the insurance.
Right. Right. It can, because when your insurance premiums increase, it's going to affect your ability to repay or to meet your other obligations. So yes, that is true, and it would be affected. Students, are you following the conversation, or did we leave you behind?
You left me behind.
All right, tell me where we leave you.
Wait, I didn't hear the last thing that was said just now.
The last thing. So you heard what I said about motor vehicles, or
Yes, I
about
did.
it? All right. So and then we spoke about whether your vehicle was insured comprehensively or third party. You heard that part?
No, I did not.
All right. So we're saying if your vehicle is insured third party for third party risk only, most likely you're not going to get anything if an act of God damages your vehicle, because there's no third party involved. But if you had a loan on that vehicle, every institution where
Sorry, a question.
yes.
I've seen videos where animals, not in Jamaica because we don't have animals that big, but I've seen videos where animals destroy cars. Would that be an act of God?
No. When you say
Oh,
animals,
okay.
you mean unlike when you have stray animals on the road and we let them, or you mean they purposely go
Like
on?
I've seen videos where, as I said, it's not in Jamaica, but I've seen videos where deers go up to cars and like book them and put
Oh,
dents in them.
oh, I see. Well, if your car is comprehensively insured, there's a possibility you can be compensated for that. You can claim on your insurance to fix it. However, there's a thing they call excess, right? In insurance, where if the damage doesn't, any damage done to your vehicle, there is a portion of it that you, the owner, are expected to bear. And that amount is called the excess. So they normally call it 5% or 10% of the insured value or whatever it is. It's 5%, I think. So let's say, for example, the cow come and kick your door and put a proper dent in the door. But to buy back a door is less money than the excess. So it's your expense. The insurance not going to pay for it, because the damage or the replacement cost is below the excess. Did I lose you,
Okay.
or are you still with me?
No, that makes sense.
No way.
All right, great. So that is insurance. So insurance is basically one of the methods that the financial institutions use to try and supplement or reduce credit risk as well. So even though we take the collateral, we also want insurance on the collateral, because anything can happen to the collateral, right? And that applies to your motor vehicle and your furniture too. You can take insurance on your furniture and appliances and your real estate, right? Okay, moving along. We're still talking about, why is my thing not going? We're still talking about reducing the risk, right? So another way that the financial institutions reduce risk is they make sure that the payments that are to be made on the loans are automated payments, such as standing orders and salary deductions. Everybody know what standing orders and salary deductions are? Is there
Salary
anybody?
reductions as in like they take out a portion of the loan. Not a lot, not like too little either, like a portion of the loan and out of your salary.
Not a portion, is the whole loan payment them take out.
Oh,
So yeah, all of it.
not funny. Why do they take
Not
out?
one time, not all at once.
No,
Oh.
your monthly payment. So remember we spoke about our loan repayment schedule, and you tell me that you're doing we call it theory of interest and stuff. So you get a repayment schedule and you have a monthly payment, right? on your loan. That monthly payment, what they do to reduce the risk of you're not paying your loan is they set up a salary deduction. So the monthly payment comes out of your pay each month before you get it.
Okay.
Okay, but what are standing orders? I process standing order payments and I don't know what those are. I'm wondering if it's the same thing.
All right. So for those instances where your employer is not of the mind of processing salary deductions, then a standing order is put in place. And what that is you say to your bank, every month, I want you to take out this amount and send it to that person. That's basically what it is. So it's you giving your bank authorization to make a standard payment within a periodically to a specific recipient. Follow?
Follow.
Yes, miss.
Right. So I could put a standing order in place to pay my loans. I could put a standing order in place to pay my insurance premium. I could put a standing order in place to even pay JPS or anybody else or my credit cards. It's up to me, right? But the salary deduction now is where the institution engages your employer. And your employer then says, okay, the financial institution and me agree. We're going to make sure that we take out this loan payment before you get the pay. And then I will send it to them. Follow? All right. Well, you can let me know if you have any questions. Well, the next measure that they use to reduce the credit risk is lending limits. And the lending limits can be applied in two ways, via debt service ratio or loan to value ratios. There's a third one because we mentioned one earlier, right? We mentioned a lending limit earlier and where they cap the amount that you can receive for a particular type of loan. So remember we said for unsecured loans, they may impose a limit by policy, say, okay, because this is an unsecured loan and the risk is higher for them, then I'm going to cap how much I lend unsecured to customers. So that's one way. And then the other two is the debt service ratio and the loan to value ratio. Everybody know what debt service ratio and loan to value ratio is? Anybody?
No.
Nobody?
I've never heard this in my life until now.
No.
All right. And Tiana, you never come across that before?
No, I've never.
All right. Okay. Well, we're going to talk about that. So that's the new thing today now. So our debt service ratio is a measure of your debt payments or your loan payments against your cash inflows or income for both individuals and businesses, right? You've done accounting, so you know what ratios are. It's showing how one particular thing relate to the other in a percentage, using a percentage to reflect that relationship, right? So debt service ratio is debt divided by, or your debt or your loan payment divided by your cash inflow or your salary or your income, whatever the source of that is. Follow?
But question,
Mm-hmm.
is there like mathematics in this course or is it just strictly a writing theory?
All right. So you see the picture over the side, you see the calculation.
Yes.
So the debt service ratio is a calculated figure. But
You said it's
each
debt-
financial institution has their own policy as it relates to this particular ratio. So one financial institution may say, my policy is no customer of mine must have a debt service ratio over 40% for me to give them a loan. And another financial institution may say, I will allow them up to 50%. Follow?
Follow.
The financial institution that I am a part of, I think that the cap or the requirement or the policy is 40%. So if you're going to be paying loans, when you're doing up, it's kind of like you're doing up your budget for the month, right? And you may owe more than one financial institution. And you come to mine and you want another loan. They're going to assess you. They're going to say, well,
Bad
currently,
decision.
so the debt service ratio is an indication of whether it's a bad decision or not. That's how they reduce their risk. That's how they assess you as to see how risky
No,
you
why
are.
you as a person borrowing from multiple people?
Okay. There may be a reasonable reason for that. Not a good thing necessarily, but not a bad thing necessarily either. You have to look at the reasons for that. So I might borrow from different institutions because different institutions offer different interest rates. Or they may offer something else that is attractive to me. So let's say, for example, I took a loan from the credit union because at the time they were running a promotion and I didn't have to pay any loan fees. And they were giving me a very good rate. So I went and I got that loan. But at this point in time, they're no longer running that promotion. So I want a new loan now for a different reason. And I'm coming to another institution because they have the best offering. Right? For that particular thing that I want the loan for. So not a good thing if you're borrowing from Tom, Dick, and Harry. Yes, that's true. But if it's say 2 institutions or maybe 3, and there is a reason behind it, there is reasoning behind it, and the reasoning behind it is going to show up when you work out the debt service ratio, right? That can show it up. And it just may be that you're probably near the end of that loan with that other institution. So it might be 2 institutions, now it can go down to 1. Follow?
Yes,
But in general, once you do your assignment, you will see what dealing with multiple institutions will cause. Once you do that assignment with credit rating, right? So yes, so we're looking at our debt service ratio. So somebody was concerned that his peer writing and no calculating going on in the class. Who was that?
Miss?
Yes? That was you? You're concerned that we're not doing any maths in the class?
Yes, it was me.
All right. Well, it's not all going to be maths. There is a little maths to it. But in most cases, it's credit risk policy that we're going to look at. And policies don't always involve calculating necessarily. This course is going to teach you the concepts and the theoretical concepts that are used to address credit risk as it relates to lending, right? So it is going to be a lot of, I'd say, theory, but some aspects of it relates to calculating, yes. Not all and not many. The debt service ratio is one of them where you have to calculate. So in the same way that you would calculate your expenses, and different institutions approach this calculation differently. If you went to Victoria Mutual and you were taking a mortgage, they want to know how much you pay for light, how much you pay for water, all of them something there before them calculate your debt service ratio and tell you whether you qualify for the loan. Not every institution is going to get that granular. Following what I said?
Following.
Right, great. So some institutions will do that. Some institutions will say, how much do you earn? What other loans are you paying? Do you have a credit card? And if you have a credit card, they're going to take a monthly payment, calculate a monthly payment assigned to your credit card, and they're going to come up with the debt service ratio. And as I said, they will assess you based on their internal policy. Whether you're allowed to get to 40% or 50%, that is what is going to determine whether you qualify for the loan. For businesses, the debt service ratio is a little bit more technical, right? It's the earnings divided by what you pay for the loan. And businesses normally pay their loan in a different way from individuals, most cases. But let me ask you a question. You guys are doing principal, what you call the interest course that you're doing? Principles of interest?
Theory of interest.
Theory of interest?
Yes, ma'am.
All right. So in that course, did you do, or did you look at the difference between a reducing balance loan and a straight line loan and how interest is applied?
No.
No?
Nope. No.
No.
Has your course been concluded or is it one that you're doing currently?
It's finished.
It's
Well,
finished?
the one that I am redoing.
Oh.
And then they don't do that? So what are you doing there?
That sounds more like accounts to me, though, you know. That
It's
they would
not
do.
accounts. It's not accounts. It's not
w-
accounts.
wouldn't you the
Oh,
straight
I
line?
remember. I think I remember something about the straight line. I'm not sure if it was a straight line specific. Sorry. But
Okay, so normally when I'm teaching you guys like you know at the lower end, simple interest, compound interest, you normally talk about the same like the straight line balance or the reducing balance method.
Right.
Right. So
That's
it is
accounts.
it's accounts because I mean I do that with math I do that in mathematics, but they never needed to do the foundational courses because these are all the bright ones, so they came in, you know, and moved into the upper level courses. But yeah, man,
So what
it
do
is
they cover in principle in the theory of interest? What do they cover?
okay, guys. If there's a question, go ahead, answer up.
can you repeat the question, please?
What do you cover in the course theory of interest? What was the material? What did you look at in that class?
Simple interest, the accumulation function, compound interest,
Mm-hmm.
rates. I don't remember what rate, but so far we're at accumulation function. That's where we are right now, I think.
Accumulation function.
Yeah, but truth be told, though, guys, based on what Joanna just said a while ago, you should learn that at that point as well. Once it is that you're doing simple interest, compound interest, you'll have to use at that point the straight line or the reducing balance methods. But anyhow, I can speak with Mr. Kelly about that one and see what happens.
Sorry, Mr. Kelly is not my teacher.
Mr. Sylvester.
Thank you.
Okay. All right. Wherever it's covered, whether it's in algebra or it's in theory of interest, I just thought it would have been in theory of interest because I thought it was a direct relation to interest and how interest is applied. So that's why I thought it was covered there. But in essence, the reducing balance, most business loans are looked at in the interest is applied differently from where individuals take loans. So most times the individual loans is a straight line loan or a reducing balance loan. But for the businesses, and you pay one standard monthly payment, and your loan repayment schedule that you receive as an individual will show you the split between interest and principal each payment that you make. But for the businesses, the interest is a separate payment from the principal repayment, right? So it's two different payments that a business is making on their loan.
Oh, sorry, excuse me. We did do it. Because when you mentioned principal reduced and all that, I remember it's amortization schedule.
Right. When your amortization, right. Great. I'm glad that you did. So So for the businesses, when we are calculating their debt service ratio, we look at their earnings and that is divided by the total debt payment, which is principal plus interest, to find out what that is. And again, each institution is going to have a policy on what is the maximum debt service ratio that is allowed for lending, right? I have here, so the earnings that I use for small, well, for my institution, the earnings that I use for small businesses, earnings before interest, tax, and depreciation. And since you did accounting, that's not supposed to sound like French to you. You follow?
Following.
All right, marvelous. Okay, so we made mention of the loan to value ratio earlier, and this is another method used in the policy making to reduce credit risk or to define what we call the risk appetite of each institution. So the loan to value ratio refers to the collateral value that can be used as security for the loan. And earlier, Mr. Shan said, if you're going to use life insurance, sometimes they restrict you, so you can only use 50% of the cash surrender value, or you can use 20%, or that kind of thing, right? That is a reference to a loan to value ratio. So in other words, the institution is determining how much value they place or they will use as collateral for a particular security. So let's say, for example, our new vehicles. Most times these days with the new vehicles, you can get 100% financing. And 100% financing is the same thing as saying it's 100% loan to value ratio that is used, right? But for the used cars, they don't tell you 100%. They will tell you that the loan to value ratio applicable for the used cars is 70%. If it is 5 years, 50%. If it's older than 5 years, they make those distinctions. Everybody has come across that before or has noticed that. Well, if you don't notice it yet, you're going to get an assignment to notice it. But in essence, that's basically what loan to value ratio is. Do you understand loan to value ratio now, or do you need me to explain a little bit more?
Please can I explain that to more, please?
All right, so let's go for a scenario where, let's say, for example, you have an investment, right? And you want to use this investment as collateral for a loan. And you approach a financial institution to say, I need to take a loan. What I have that I can put up as security is I have an investment. And the investment, the lender is going to ask you, what type of investment is it? Because there are different types of investment. You have bonds, you have certificate of deposit, you have shares. You know, your investment can be different types. And they will say to you, well, our policy is if you're going to pledge shares or if you're going to give us shares as a security, we don't go more than 50% loan to value ratio. If we're going to take cash deposit, we go 100% loan to value ratio. And loan, it means how? When you say loan to value ratio, it's the value of your loan versus the value of the collateral that I'm willing to take, right? So for shares, I don't know if you are familiar, but the value of shares fluctuates. It's a variable value that is applicable to shares because it's based on trading. So no lending institution is going to tell you that if you're going to pledge shares that I'm going to take 100% of what those shares value today. They're not going to do that because they are set to lose because the price of the share can go down tomorrow, right? So they will say to you, in order to protect myself, my loan to value ratio applicable to shares is 40%. Anything with value today, me only willing for hold 40% of it because I'm not guarantee the next 60%, I can get it back. Follow? That any clearer?
Yes, ma'am.
Kind of.
Right. So loan to value ratio is about the amount of the loan that I'm willing to give you versus the amount of value I'm willing to take from your collateral, or that I think is safe for your collateral. So same thing with your cash surrender value now on your life insurance policy. The lending institution may say, okay, your cash surrender value is 100,000 based on the statement that you give me for last month, right? But I don't want I'm not gonna say I'm gonna take the 100,000 fully if anything happens. I will go 50%. And that might be because they might have a conscience and say, well, when it comes on to life insurance, really it is is something that is for the individual to secure the individual and any eventualities. So I'm not going to take all of it. I'll take 50% of that cash surrender value. Plus, the same institution that give you that life insurance, they're going to take out fees and all manner thing before they give you that cash surrender value. So I will assign 50% to that kind of security if that's what you're bringing to me. All right? At the end of the day, the only reason why they go below 100% is because of the risk of not getting back the full amount that is on that particular security. Okay. So this is my last slide for the evening. And what we're going to talk about, we've been talking about collateral and loan to value ratios and debt service ratio and how, the bank is trying to, or the bank and the lending institutions are trying to reduce and control the risk that is associated with lending. And I said earlier that risk is related to rewards. First thing Tatiana said, listen, one thing we know about loan, the interest is a killer. That's the first thing she said. Interest is every financial institution's reward for lending. And so whatever risk is associated with the particular types of loans is going to relate to how much interest rate or how high the interest rate is on these loans. So the best security is a cash security. So the cash secured loans are supposed, and in general, secured loans are supposed to be cheaper than unsecured loans, correct? Everybody agree? Yes. The secured loans are supposed to be cheaper than unsecured loans. And the cash security is the best security. That is supposed to be the cheapest loan too. Don't?
Yep.
Right, because you can get back your money quick and fast. If the person defaults, you can just take your cash, right? I did an extract from the Bank of Jamaica where they showed the commercial bank loan rates, the recent rates. And if you look at the table that is on your screen, you can see that plays out in this table. The largest interest rate that you're looking at is for installment credit. And the smallest interest rate that you're seeing is for commercial credit. But there's more to this than meets the eye. You notice that businesses are getting lower interest rate than the individuals. How comes? That not look funny. What was that? No, oh, everybody get quiet. It's what happened.
I guess I don't know how to answer that, to be honest.
All right, so let's look at the personal credit column. The personal credit column has a very high interest rate. And that particular column is looking at the unsecured aspect of personal lending. So unsecured loan rates are higher because the risk associated with unsecured loans are higher, right? Now the installment credit column is more speaking to those loans that are secured. So there is some security or collateral for those loans. And that rate is lower than the personal credit rate, which is for unsecured. You notice it's less than half. You see that great disparity in the rates, and this is the rates across more than one financial institutions. It's not one institution. This is all the institutions that the Bank of Jamaica would have oversight of, and they're showing you the rates that are applicable to these types of loans. And when you look at the mortgage now, the mortgage loans is 7.16 to 7.36%. I think rates have gone higher than that now since August, actually. But it's one of the lowest rates. And it's one of the lowest rates because real estate is a very good security. And the truth of the matter is it's also the largest loan that an individual is going to take. Can you imagine if we had to be paying 10% for a real estate loan? We couldn't afford it.
And isn't it over a longer period of time too?
And it's over a longer period of time. Right? So it's just showing you this table really, and this particular slide is just to show the relationship between risk and interest rates. So the riskier the loan, the higher the interest rate applicable. So like even credit cards have very high interest rates. 40%, 45%, 47%, 50% in some cases. Which is why I am very much gonna encourage you guys to be very careful with credit cards. It's not that you can't have one, but you gotta be very careful in the use of credit cards because that particular facility attracts the highest interest rate. And they are usually unsecured for persons. Only the businesses get secured credit cards, and so their rates can be lower. But for personal credit cards, most institutions, there's no security affixed to it. So the rates are higher. Anybody here have a credit card?
No, only debit card.
Miss, I think some things are out of the pit of hell. And I think credit cards is one of those. Very useful. It's one good way of building your credit. But if you're not responsible, you're kind of
Yes.
dog. You're kind of
Yes.
dog.
Yes,
It's
indeed.
the only.
What are you saying? Go ahead.
Oh, I was saying that the only credit card I have is like a US card, but their credit is or debit and or debit is their credit.
Oh, I see. It's
Say
just
that-
that
say that-
they call it a different term.
Yeah.
Different, same thing. It's a debit card. It's like a check card.
Yeah,
You
but
can't-
like,
Go ahead.
oh, I was saying that when I go to the bank, I'm
Mhm.
afraid that they charge me because I have to draw from credit and not debit.
Oh,
But they
No,
don't.
man, it's just the account that you're drawing from.
Sir, what you said?
I'm just saying that's the account that you're drawing from, but it's still it's like a check card. It's either a Visa or a MasterCard, similar to our debit cards out here. So you can only draw what it is that you have.
Yeah.
Mhm,
It's not a
mhm.
line of credit.
Right. Not a line of credit. So tell me something now. I want to ask you guys, would you take a cash secured loan, and tell me why? What are the arguments for taking a cash secured loan?
A lower interest rate.
Yes. Anything else?
Is it that it's easier to pay off than the unsecured, or it doesn't matter?
It doesn't matter. Your ease of paying is basically dependent on your earning ability or capability. So whether it's cash secured or otherwise, it wouldn't affect how easy you're going to pay off that loan.
So,
But here's the thing now. So if you have your cash, why would you go and take a loan? That is what Tiana would have said, but she not talk.
Yeah, and I was waiting for Tiana and Dana to respond
Me
before I
wait for Tiana to tell me, so then why would I go and take a loan if I have my cash?
Tiana, respond before I respond, Tiana. Please, I want to hear your thing because, boy, I mean, you can be rich, Tiana.
I should answer your question. Why would you go and take a loan if I have cash?
Yes.
I wouldn't do that. But for people who would, um, as you said, there are other reasons as to why someone might go ahead and do something like that. So, but personally, I wouldn't.
Boy, Tiana, you're destined to.
But why is it easier than unsecured though? That's still the question, right?
No, I want to know what are the arguments for taking a cash secured loan. I asked, would you take one? So your answer is no. But I'm asking, what are the
No, the the aim is to always stay away from debt.
Like,
But you
don't.
said it's impossible because you're going to need mortgages and stuff.
yes.
Miss knew this, Tiana. She just pulling your legs. We all know this. Dana,
Yes.
what say you before I respond, Dana? Go ahead, Dana. Dana, drop asleep.
I wouldn't take one, but
You
I
wouldn't
think
take a cash secured loan, Dana?
no.
Okay. Tell me, what is your reasoning though?
It's a loan in general. I just don't like owing people money.
All
Over.
right.
Yeah.
Oh boy. I guess they will learn as they grow up. I would take one.
Yes.
I would take
Yeah.
one, and my reason for doing this may not be correct, but what I find as I get older, it's
Mhm.
that you, well, let me not generalize, but I'm saying I find it hard to pay myself. So if I have my liquid, my cash, if I have $500,000 and I need to do a home renovation for Christmas, for argument's sake,
Yes.
I would want to go and use up my 500,000 because it will take a longer time for me to save up to that 500,000.
Yes.
When I take a loan, because it's a
Mhm.
cash secured loan, the interest rate is going to be lower. And then I
Mhm.
know that I'm going to commit myself to paying off back this loan. So within a year or 2 years or 6 months, whatever the
But
time frame.
isn't that basically the same thing though? Wouldn't that be like a discipline issue with yourself?
Not
Because you
necessarily.
still have to save back
I would
the
still
money
earn
that you're
interest.
borrowing.
No, but I will still earn interest on my money, even though the interest is not going to be much. But at least I know that I still have that amount of money. But it's just that I'm paying. Okay, Tiana, the point I'm making is if I take up that 500,000, yes, it's going to cost me more because I'll have to pay interest on it, though the interest is not going to be an exorbitant amount as if I were to take an unsecured loan. But at least I know that I'm paying back myself for the loan that I'm taking out to do XYZ. So within a 12 months period or an 18 months period, when I would have completed the loan, I'm still back at my $500,000. Yes, the discipline issue is that if you withdraw that money, chances are you may not want to every month go and put back that amount of money in order to build back your liquid because Miss will tell you that it's always good to have a minimum of 3 months of your salary put down in the event that something were to happen. But I would take it for that reason as also to increase my credit score, for them to see that I'm very committed in paying back. So it comes back to the discipline issue. But who would want to put themselves in a position where you just don't have, even though you just don't have no money at all. But at least you know that every month you pay back, you are increasing your liquid, your liquid cash. I mean, so to speak. I don't know. That's just my personal view of looking at it.
Mhm. Yes. And that's one way of looking at it. Yes, and definitely most persons who take cash secured loans, it's because they want to preserve their cash, or whatever they own now. They want to preserve that. They know that they won't be able to amass that amount of money necessarily, in a short period of time if they were to use it now. And when you have cash put down, if anything happens, it's it's there for you to access in case of an emergency necessarily. Not if the bank holding it though for that loan, but as you pay back your loan, less of it is being held by the bank. And less of it is accessible, more of it is accessible to you. And it's just a matter of preserving your assets and preserving your net worth, which is where I wanted to go with it. You know, you can choose if you so desire, look at it and say that another argument would be, but any loan interest I am paying is more than the interest I am earning on the cash. So I might as well use the cash and do what I'm going to do. All of that has to be assessed within your ability to put back that money and how important that money is to you as your backup or your, you know, your fail safe, then your cushion. So let's say you only have 500,000 saving up, you don't have a cent anywhere else. You're going to take all that money, go and spend it on something where you're going to take a loan and take your time, pay it off back. So it's all up to the borrower to make those types of assessment and not be swayed. You have to know your situation. It's possible that you can use that money and put it back quickly, depending on what you do. And then it might be a situation, as Mr. Shan said, where as you get older, you realize that sometimes it's harder to get back to that level. Sometimes it's harder to see that amount of money back in the account if you use it all at once. So it's best to take a loan. At least you'll be paying the lowest interest rate and you can discipline yourself and pay it off in a short time. Right? So the last concept I'm going to speak on is your net worth. Because that's another thing that institutions look at when they're assessing the customer. And your net worth basically is the amount of assets you have versus the liabilities that you have. And some people have a positive net worth and some people have a negative net worth. Which one you have? Tiana, what kind of net worth you have?
Positive net worth, definitely.
Wonderful. That's great. That's a good start. That's a good start. How are you doing in terms of network, Dana? Dana going to sleep again? All right, Jonah, you tell me about your net worth while Dana wake up.
I have not.
You have no net worth?
I don't think so.
So you're saying that your income exactly equal your debts?
But can you explain that a little further, please?
All right, so I said net worth is the difference between your assets and your liabilities. So if your assets exceed your liabilities, you have a positive net worth. If your liabilities exceed your assets, you have a negative net worth. So you know when you talk about the movie stars and they say, oh, so have a 10 billion net worth and Steve Jobs have a whatever net worth and all those rich people, when they speak about net worth, they're talking about their assets, what they own, versus what them owe. Right? So you're one positive or negative?
Positive.
Yeah, guess? Oh, that sounds like a guess answer, sir.
She doesn't sound like she's sure. She does so sure.
It's a positive net worth?
I am assuming it is. I don't owe anyone, so.
You don't owe anyone, but you own something.
Yes, I do.
Well, then that means that it's a positive net worth. And that's always a good thing when persons approach a lending institution, that you have a positive net worth. But just in case you don't anyway, that don't mean that you can't get there, right? It means that some lending institutions, their policy is, we will help you get there. So while you take a loan from us, a part of what you repay us is going to go towards your building your wealth. So I'm going to put it in an investment for you. There's an investment portion to your loan repayment. I think credit unions usually do that. So even while you're paying back a loan, you're building your net worth. And some financial institutions, some banks, depending on the product, they will also do that. So I'm going to help you to save. So part of the discipline I'm going to put on you is that when you're repaying this loan, a portion of it is going to go to an investment. And that's because a positive net worth is always a good thing. It means I can
Wait,
lend.
there when you're paying the loan, a
Yeah.
portion of the loan goes to an investment
Portion
for
of the
you?
repayment, yes. A portion of your repayment goes to an investment. So in essence, if your loan
So
repayment
isn't
is
the money
50,
going
yes.
back to the bank? I don't get that.
All right. So let's say, for example, you took a loan and the monthly repayment calculated on your loan is $50. All right. What they may do is say, okay, I'm going to add another $5 and you pay $55 every month because you can afford that based on the debt service ratio policy that we have. And you will be remitting to me $55 every month, but $5 out of that 50 is going to go to a deposit account. I'm so sorry. Okay, follow?
Yes, yes.
Right. So it's not that the money is paying the loan, the money is actually going to an investment. Some insurance policy do the same kind of thing, where you pay a premium and them claim a portion of it is investment.
And you
Follow?
actually get back that money from the investment if you want it?
Yes, you can access that if you want it. Yes.
Okay.
But it builds your net worth. All right. So I want to be sure that everybody understood what was done today. Is there any question? We're coming to the end of the class.
Not from me.
You're not
No.
following? Say again. Was that Joanna?
I was saying no question from me.
Okay. I don't hear Dana. Dana gone?
Miss, I'm here, but when you asked the question, I couldn't come to the phone.
All right. So you want to answer the question now?
Oh, yes, miss. Mine is positive.
All right. Good. Keep it that way. Any questions?
So
We
Miss,
will
you don't
talk.
Miss, you don't ask me about mine. Mine is break even.
Yes, it's break even.
So if I slip, I slide. No, but seriously though, I just I'm having my own reflective thought as I listen to the questions being asked and the responses being given, and I'm seeing where these are real life experiences, and I'm going to encourage you students to pay much attention to what is happening. It's very interesting. I I I can relate to the content being presented because of real life experiences. You're trying to get a loan. Oftentimes you go to the bank, you may have $100,000 put down, and you have school fee to pay for $75,000, and say, hey, I'm good, and I'm going to go and withdraw that 75,000. And your financial institution may say to you, then why take the $75,000? Take a loan against it. And how much can you pay? And he said, the truth of the matter is I can pay $25,000 a month. And I said, okay, fine. So why not just take a loan of the 75,000, pay your 25,000, and then you have that sort of net back into your coffers, because you still have your funds. But the notion about I don't like loan and I don't want no loan is something that as you get older, you'll recognize that notion has to go because you have to depend on a financial
Sir,
institution or
sir, I
somebody.
understand that. I understand that
Mhm.
because even though I'm here, I'm thinking about what you're saying, especially with the school thing. And
Yeah.
I'm saying it makes sense what you just said a while ago. It really does. But
Mhm.
for me, and this is just my personal thing, I feel like for me, alone would be just a one-time thing in life. Like I really try my best to avoid it. But as you know, if you want a decent house, then that's
Mhm.
not something you can save for. But when it comes down to school fees, then
Mhm.
right now I feel like that's something I'd pay for out of my pocket because it's a one semester thing. It's not like I'm paying school fee every month. So I'd pay
Right.
for it once and then the other months I'd save. So when it's time to pay for it again, it's not affecting me that much because I have like 4 other months to save up enough money for good just towards savings. So I wouldn't
Right.
necessarily take out a loan for school fees, but I take out a loan for a house. To me, it's just that one time thing or for a car.
Mhm.
I wouldn't like necessarily, oh, I have access to a loan, and I take out a loan to pay my school fees, someone can take my look at time and pay it back or saving. No. It just seems like that one time thing where you take out for some big thing that you want. School fee just doesn't seem like that big thing for me right now.
And that's fine. And that's fine. So you agree that you to take a car and to buy a house, a loan is essential, right?
Yeah.
Okay. And
Okay.
this is what I'm saying. So I agree with you. Um, the school fee at Excel is a little cheaper. What if you're doing like medicine or dentistry or law, where it is that the fees are $1 million, right? So, which is why I said at this at the last week's class that for me personally, there are three things that I personally would take a loan for. You've named two of them, and you've thrown out one of them: a house, a car, and for an education,
Mm.
because all of those will be a means to an end. And education will be able to qualify me to more money. So it is that I can pay off the loan. And me paying off the loan, we spoke about a car today. The car is a means to an end. It takes you back and forth to and from work and is a means to an end to help you to earn more money. You can do like a side hustle. You don't have to worry about public transportation, whatever the situation is. And a house is, you know, rent nowadays in Jamaica is the upwards of 50,000, $100,000. And chances are what people are paying for rent now, if they were to take a mortgage, chances are they could pay the mortgage and have a little change left over, right? Um, so these are things that you said, and I appreciate it. Maybe 5 years down the line, Miss and I will have a conversation with you again, T, and then maybe your position will change. But I was where you were in terms of me, loan. I I don't want it. I hate seeing it, but it becomes a part of your daily staple. But interesting stuff though, guys. We need to read when Miss sends the notes, and I circulated. She sent the notes last week, and I circulated the same night. It is important for us to read and to read widely because we need to be able to appreciate the content we presented. So it is that we can write good essays, we can explain the things because I recognize that the experience is not there. So when
Mm.
she's asking about credit risk, you need to be able
Mhm.
to explain what credit risk is and to give examples and to counter argue on the matter. So please, we must
Right.
read. We must read.
So and maybe Dana and Tiana and Joanna, all of you, your perspectives might change if you have children. Because things can happen with children unexpectedly, and you need to have cash to be able to manage whatever takes place with them. So remember, we're talking about the lending cycle. So it depends on also where you are in that cycle. What your credit needs will vary based on your stage, where you are in life, and your perspective and your earning ability. Um, those are some of the things that affect the decisions that you will make as it relates to lending. Um, the lending institutions try to help you by restricting you with their policies, but sometimes their policies also are too liberal and they might not be the best thing for you. So whereas a lending institution might say, my total debt service ratio limit for customers is 40%, you may need to look at your own situation and say, no, sir, that's not too much money I come out of my pay for just loan alone. I restrict myself to, when it comes on to loans, only 30 or 20% of my pay should be going to that, because I have other things to take care of, and I need to be able to do these things without fretting and losing sleep at night time, right? You need to develop the responsibility. At the end of the day, the responsibility for your own actions and the loans that you take. Don't make nobody shove nothing down your throat. I will close off by saying that one of the instances that took place in recent times as it relates to lending, and it was overseas and in Jamaica as well, it affected Jamaica because some of our banks have overseas links, was that lending officers were issuing facilities to customers that they didn't agree to. So they would send a credit card or issue a line of credit, and the customer never signed up nothing for it, and they never explained the features of the products to the customers necessarily, and all of a sudden they have this credit, right? And that is not a good thing. Each individual needs to make the decision themselves on whatever credit they're going to be committing themselves to. And you need to be aware of all the requirements and features of these products when you take them. That is the end of my class today. Are there any questions? We've gone over time.
Mrs. Would go back to the first slide, please.
To the which slide?
The first slide.
The very first slide.
Miss, you're gonna send this, right?
Say again?
If you're going to send this.
Yes, but I kind of feel like when I'm not reading the things then when I send them.
Oh,
Since
Miss,
I sent last week and nobody don't read it and can't answer the questions I
didn't get last week.
You didn't get last week?
No.
Who is that saying they
Excuse
didn't
me?
get last week?
Excuse me?
Sure, you said
Tiana, did you get it?
the slide.
Yes, sir.
Did you get it? Did you get it, Joanna?
Oh,
Yes.
yes, sir. Sorry, my bad. My apologies.
You see what I'm talking about?
Okay, thank you. You are forgiven. Did you see the assignment that me sent to Dana?
Yes, sir, I started it.
Okay, bless the Lord.
Please work on your assignments. It goes towards your grade and I need for them to be done nicely. Your deadline is November 15th. For those who didn't hear or didn't see it, the deadline is the 15th of November, 10 p.m.
I have a question.
Yes?
In what format do you want it? PowerPoint or like a document?
I want a document. I don't want a PowerPoint.
Okay, just making sure.
At the end of when I go through your assignment, I should understand what credit scores are and how they work, how that works in Jamaica. What is a good score? What's not a good score? What are the things that I should or shouldn't do to affect my score? I'll try to be lenient as much as possible, but I expect you guys to give me good material. All right, so who wanted me to go back to the first slide now? What you want to ask on this slide?
Oh, I was just screenshotting it.
Oh, I see. What did we say about land? You remember?
About land,
You can't have insurance for
you
that.
can't insure land.
All right. Well, they don't. They don't. They only insure what is on the land. All right. If there are no other questions, then Mr. Shad will share the information with you. And I look forward to seeing you next class, which is Wednesday at 6.
Bless you. Thank you
Okay.
again, miss, for your commitment. Thanks, guys. Guys, please to read. Please to read. I am doing my own reading too, you know. So come, you need to read. Come on, man, guys. We need to read. Thank you, miss.
All right. Have a good evening, all.
Bless you. Take care.
Good night. Bye, miss.
Bye-bye.
Remember to send a slide. Thank you.
All right.